In this session, we are going to look at the analysis of active portfolio management, wherein we would be focusing on what is the value added. How do I really measure how much of value is added because of active portfolio management? So, that is what will differentiate portfolio manager 1 versus portfolio manager 2, who has really performed well compared to the other. So we need to have a foolproof mechanism in place which talks about how to measure the value addition that is really accomplished by the active portfolio management. And in that context, we would be talking about differentiation between the two different ratios which are used for measuring the performance of the portfolio managers. One is the information ratio, which is almost called as active return to active risk kind of ratio, and a Sharpe ratio, which we know as the return on the portfolio minus the risk-free rate of return divided by the standard deviation of the portfolio return. So differentiation between these two. Then we will be moving on to understanding the fundamental law of active portfolio management, and towards the end we will be stressing on the strengths and limitations of the fundamental law of active portfolio management. So when we are using the word active management, the major intention is to add value. Right? I am doing an active portfolio management means the portfolio manager is doing some kind of a research on the securities, or he is doing a planning with respect to the various asset classes, and he is deviating something from the benchmark, and he wants to really provide some additional positive returns, expected positive returns, which are beating the benchmark. So the otherwise he could have simply followed a particular benchmark like the index. He could have simply mimicked the index S&P 500 or Nifty 50 or whatever it is. He could have simply mimicked the index, and he could have generated the return that the index is generating. That is passive management. But when we are doing active management, the intention is try to perform better than the benchmark. So the selection of the asset classes, selection of the securities within the asset class, they are all dynamic. And the main objective is to generate a kind of a return which is much better than the benchmark portfolio. So the performance, when I say performance, the return with respect to the risk that is being taken, it should be compared with respect to the benchmark that has been chosen. And benchmark is always a passive kind of stuff. It doesn't change drastically. And so there we can say, if the investor has generated a return RP which is greater than the return that the benchmark has generated during the same process, then we say that the investor or the manager has really outperformed the benchmark. Otherwise, I say that he has underperformed the benchmark. So which means this becomes a very crucial thing. What should be my benchmark? Now, I can't choose anything and everything as a benchmark. It should be a good reflection of those securities which the investor is choosing. If the investor is choosing all small cap securities from the Indian market, then You can't have the Sensex as a benchmark for it, because Sensex is a combination of all large cap stocks, 30 large cap stocks that are listed on the Bombay Stock Exchange. But as an investor, I'm investing in all small cap stocks. So my benchmark, selecting Sensex in that case, is not an appropriate benchmark. So the benchmark that I'm choosing, it should be a good representation of the assets that I would be investing in, and it should be in such a way that I should be able to replicate the positions in this particular benchmark at a very low cost. Means there should be some kind of tools and techniques that are available, or some kind of trading that is available, where the position of the benchmark can very well be replicated quite quickly at a much lower cost. That is what we call as the benchmark. The weights of the various constituents of the benchmark, let's say Sensex is my benchmark, the weights of the various constituents of the benchmark are verifiable. Before we invest itself, we know what are the weights that have gone into the computation of the Sensex, and returns data is available for all the periods. So generally we use all the security market indexes which have both these things. Weights are verifiable ex ante and return data is available ex post. So because both of them are available, we generally see different kinds of security market indexes which are either market capitalization weighted or floated market capitalization weighted kind of indexes, typically used as benchmarks. So here if we see the return that you are getting on a benchmark, I am looking at the weightage that goes into the benchmark and multiplied by the return that that particular benchmark has generated. I'm summing it over all the n different constituents of that particular benchmark. So the weight of that constituent in the benchmark multiplied by the return of that particular constituent. Whereas the actual portfolio is the weight of that particular constituent in my portfolio multiplied by the return of that particular constituent. So the returns are more or less the same, but the weights are different. Right? The security returns I am taking RI only in both the cases, but the weightages that I am giving to each of the securities, each of the constituents of that benchmark is different. And that is where the manager's skill is coming into picture. And that difference is what we are calling as value addition if it is positive, otherwise underperforming the benchmark if it is negative. So that is that value add, we call it as active return. Whatever is the portfolio's return minus the benchmark return, that is what we are calling as the active return. And while measuring the performance, it has to be risk adjusted. I can't take it as it is, because in some cases a particular portfolio manager could be taking much higher risk. He would have deviated from the benchmark quite drastically, so his RP minus RB could be much higher or could be much lower. So whenever we are trying to measure this value add, it has to be risk adjusted, which means it has to incorporate what is the expected return that you have to get in correspondence with the risk that you have taken for your portfolio. And that is what we call as the alpha. If you remember, the return of the portfolio comes out as 1 alpha, which is the security specific return, plus beta P times RP. Means this is the benchmark return, sensitivity with respect to the benchmark, and something additional. So this alpha is what is very important. So I'll always look at this alpha as the actual return my portfolio has generated minus the return which my benchmark has generated multiplied by what is the sensitivity of my particular portfolio with respect to this benchmark. So if this is what is called as alpha, if this alpha is positive, then the investor has actually exceeded the benchmark or outperformed the benchmark, and if it is negative, he has fallen below the benchmark. So overall, if I am looking at the value addition, which is the difference between the portfolio's returns minus the benchmark return, so the value added, we are actually looking at two components in it. One, the asset allocation change. I'm changing the allocation of the asset. So I'm changing the asset classes. In equities, instead of 60%, which is there as a part of my plan, I went with 50%. Or a particular sector in equity, let's say banking sector, as per my benchmark, the banking sector has 25% investment, whereas I am investing only 20% in the banking sector. So my asset allocation has changed, the weights have changed. So that is one part of the value add. And within this asset classes or sectors, okay, banking sector I have gone with 20%, but instead of going with 8 banks that are there as a part of the benchmark, I have chosen only 3 banks. Means my security selection also is different within that asset allocation. So my overall value addition, I can always look at it as a combination of two items. That particular value that came because of asset allocations changing from the benchmark, and two, because of the choice of the individual securities as a part of that asset class. And these two, wherever I am deviating, those are the ones that are contributing to the value addition. Let's look at one simple example, right? A portfolio manager, this is how he has, as per the benchmark, he is supposed to invest 40% in domestic equities, 30% in international equities, and 30% in bonds. Whereas he took a deviation and he has invested 55% in domestic equities, 20% in international, and 25% in bonds. And the benchmark wise, right, whatever these 40, 30, 30, they are supposed to give returns of 8, 9, and 6. Whereas this person, he has actually deviated even in the stocks. That's the reason the portfolio's returns were 10, 10, and 5%. Now I want to find out the value added for this entire portfolio. Now, the simple way of looking at is take each of them separately. Right? You take the weights and the returns of each one of them. And so first let's find out the return that your portfolio has given. The return that your portfolio has given, whatever is the difference. So you have invested 55% and it has given a 10% return. So 55% into 10% is 5.5%. Similarly, you have invested 20% in international equities, which has given 10% return, so 2%. You have invested 25% in bonds, which has given 5% return, so 1.25%. So overall, your portfolio has given 8.75% return. So that's the kind of a return that your portfolio has actually generated. Then what about your benchmark? you are supposed to invest 40%, which will generate 8% return. So your return is 3.2%. 30% generate 9% return. So overall it is 2.7%. And remaining 30% should generate 6% return, which is around 1.8%. Now if I combine all these, this is around 7.7%, which means the difference between the two is the value added or the active returns, and that active return is around 1.05%. And out of this 1.05, one thing that you look at is because of the deviation from the portfolio weights, what is the return that you have generated, right? So this 1.05, if I have to really break it up, 1.05 if I have to break it up, first part is because of the deviations from the portfolio. So 15% is the deviation in domestic equities, which would have fetched 8% return. Similarly, minus 10% is the deviation in international equities, which would have fetched 9% return, and minus 5% in bonds, which would have fetched 6% return. So if I had just deviated only in the weights, my additional return, here it is 1.2%, minus 0.9%, minus 0.3%. So because of the deviation from the benchmark, I would not have gained anything, right? Though the weights are different, I would not have gained anything because of that deviation. Whatever that extra 1.05 I have gained primarily is because of the change in the returns that my portfolio has generated. The change in the return. So this 55% has generated an additional 2% return. The 20% has generated additional 1% return, and 25% has generated additional a negative 1% return. So overall it is falling out to 1.1% plus 0.2% minus 0.25%. So purely the securities selection has given me 1.05% additional return, whereas my changing the weights of the portfolio from the benchmark did not give me any additional return. That's the way I decompose the value added. Here the value addition is purely because of security selection and not much due to the asset allocation for this specific example. Then we are looking at two major measures in this context: Sharpe ratio and information ratio. We know Sharpe ratio is nothing but the difference between the portfolio returns and the risk-free rate of return. I divide it by the standard deviation of the portfolio return. So this could be ex ante or ex post, whatever is the return. So either I can go with the expected return, which is ex ante, or realized, which is ex post return. I look at it with respect to risk-free rate of return divided by the standard deviation of the return. So I look at the portfolio return in excess of the risk-free rate, and I divide it by the volatility of the return. And this value is used for comparing the performance of the two portfolio managers per se. Whereas on the other side, if you look at the information ratio, in the numerator more or less it looks the same, except that instead of RF I am using the benchmark. Instead of using the risk-free rate of return, I am using the benchmark, and even in the denominator Instead of using the standard deviation of the returns of the portfolio, I'm looking at the standard deviation of the active returns, the excess returns over the benchmark return. That is what I am taking in the denominator. Again, this R's, the return could be a expected return, which is ex ante, or the realized return, which is ex post. And here we are very clearly making an assumption that the beta of my portfolio with respect to this benchmark is always exactly equal to 1. Otherwise, I have to make the adjustment even with respect to beta. So here one of the major assumptions in the information ratio computation is we are assuming that the beta of the portfolio that we are tracking with respect to the benchmark portfolio, the beta is exactly 1. And the information ratio is heavily affected by the use of cash because your return is changing. Use of leverage, your leverage return is changing. But even if I change the weights, it hardly changes because the weights are changing both for the actual portfolio as well as for the benchmark portfolio. And even the standard deviation is reflecting that changes in the weight. So information ratio does not change with the change in the weights. But if I'm using the cash or any other form of a leverage, because my returns are going to change, I could see a change in my information ratio as well. And this is the kind of a relationship we observe. The square of the Sharpe ratio of the portfolio is equal to the square of the Sharpe ratio of the benchmark plus the information ratio square. This is the typical relationship that you could see. The square of the Sharpe ratio of the portfolio, right? If required, we can very well look at it. Rp minus Rf by sigma p squared is equal to, if I do the same for the benchmark, Rb minus Rf by sigma b squared plus information ratio is this one. So Rp minus Rb divided by sigma of Rp minus Rb square. Simplification will give me these two are more or less equal. And if there are unconstrained portfolios, or the other way of expressing this from here, standard deviation of the difference. Here RA is nothing but the difference between RP and RB. So standard deviation of RA is nothing but information ratio divided by the standard deviation of Sharpe ratio of the benchmark multiplied by the standard deviation of the benchmark return. So that is what is the kind of a relationship that we are typically getting. Information ratio divided by the Sharpe ratio of the benchmark multiplied by the standard deviation of the benchmark return. That's one more relationship that we are obtaining. Let's see a simple relation here. I know this is the information ratio. So the standard deviation of RA is same as RA divided by IR. Right? RA divided by IR. Now this is the Sharpe ratio of the portfolio. The Sharpe ratio of the benchmark is nothing but RB minus RF divided by sigma RB. Right, this is what will come out. and here RA is nothing but, I can write this RA as RB minus RF, sorry, RP minus RB. This is what is my RA, return on the portfolio divided by minus the return on the benchmark divided by IR. Now from here I can very well find out what is the return on the benchmark. I can very well take the return on the benchmark. So the return on the benchmark is nothing but the Sharpe ratio of the benchmark multiplied by the standard deviation of the return on the benchmark plus RF. So this is how I can go on doing the simplification part. So instead of RB, I substitute this. So it becomes RP minus Sharpe ratio of B times the standard deviation of RB minus RF divided by I. We can very well adjust the things to really bring out this kind of a relationship between the standard deviation of the difference active which is the active risk. This is nothing but the active risk. Standard deviation of the active return is nothing but information ratio divided by the Sharpe ratio of the benchmark portfolio multiplied by the standard deviation of the returns of the benchmark. And expected information ratio is the basic major criteria if I really want to create actively managed portfolio. Because if you see here, this is the benchmark, this is the Sharpe ratio of the benchmark. These two are more or less the same. IR is the one that differs from portfolio to portfolio. So depending on how much IR I want, what is the IR I am expecting, I can construct the active portfolio. Active risk, active return are primarily driven purely by the information ratio. And if the IR value is much higher, obviously I am going to get higher Sharpe ratio and vice versa as well. Let's look at one simple numerical on these lines. Let me assume Let me assume S&P 500, which is a benchmark, whose expected annual return is 9%. Standard deviation of the returns is 18% and Sharpe ratio is 0.333. And I am tracking a particular fund called XYZ fund, whose expected annual return is 10.5%. Standard deviation of the returns is 25%. The Sharpe ratio is zero point 0.3. Active return in this case is 1.2%. Active risk is 8%. Information ratio is 0.15. Right? So probably here this is not required also, because information ratio is nothing but active return 1.2% divided by active risk 8%, which is giving me 0.15. So I could directly use this information ratio also, fair enough. What is the maximum Sharpe ratio that a manager can achieve by combining the S&P benchmark and XYZ fund? So we know the Sharpe ratio of the portfolio squared is equal to Sharpe ratio of the benchmark squared plus information ratio squared. So this is what I can very well take. The maximum, if I am really looking at, the Sharpe ratio of the benchmark is 0.333. So I take it as 0.333 squared plus information ratio squared, which is 0.15 squared. So whatever is the number that I can achieve, that is the maximum Sharpe ratio that I can very well get. So probably if 0.333 squared plus 0.15 squared, if I am simplifying, it might work out to somewhere around, let's say, the Sharpe ratio, which is the square root of all this. let's say I am getting somewhere around 0.36. So right now the Sharpe ratio is only 0.3, but I can very well take my Sharpe ratio to up to 0.36 in case I am combining the benchmark along with the XYZ fund. So otherwise we'll do a quick calculation as well. Okay, if I'm executing it on my calculator, it is working out that it is the Sharpe ratios of the portfolio squared is working out to some 0.1334, which means the square root of that, which is Sharpe ratio, is working out to 0.365. So that is what is working out as the Sharpe ratio. So it can't be zero point 0.3, I can very well increase it to 0.365. Find the weight of the active portfolio and the benchmark portfolio. So if that is the case, what is the combination in which I have to go with my active portfolio as well as the benchmark? So this is where I want to first find out my active risk. Right? If I am combining these two, I need my active risk. So I'll take the standard deviation of RA. I'll use the formula that we have used in the earlier slide. The standard deviation RA, I'll use this as my base. Standard deviation of RA works out to information ratio, which is 0.15, divided by the standard deviation of the benchmark, which is 0.333, multiplied by the standard deviation of, this is divided by the Sharpe ratio of the benchmark, multiplied by the standard deviation of the benchmark, which is 18%. So from here I get the optimal active risk is 0.15 by 0.333 into 18%, almost half of 18. So if you execute it in your calculator, it is working out to some 8.11%. So this is what is coming out as sigma RA. So which means my weight, if I have to look at the weight on the active portfolio, it should be 8.11% divided by whatever is my active risk, which is 8%. So weight on the active portfolio of XYZ should be around 1.014, which means the remaining should be the weight on the benchmark minus 0.014 should be the weight on the benchmark. If you want, you can even check that out. So I can go with an optimal allocation of 1.014 in the XYZ fund and take a short position of 0.014 weight on the benchmark portfolio. So which means the what is the overall return that I am getting? I am taking 1.014 times the active return, which is 1.2%. So the excess return that I am going to get on my on this combination is around 1.217%, which means the overall return, if I include this over the benchmark return, which is if I'm including it over the benchmark return, which is having an excess of 1.217%, I can very well get 1.217% over and above the benchmark kind of a return. Right? And that's it. Now, let's move further to look at some other numerical. The benchmark portfolio I'm taking as S&P 500. Which of the following three portfolios can be combined with the benchmark to produce highest combined Sharpe ratio? Yeah, we have already discussed that. Right, something which I can combine to get the highest possible Sharpe ratio. In each of the cases, if I want to see which one can give me the highest possible Sharpe ratio, I have all this information. Expected return is there, standard deviation is there, Sharpe ratio is there, and for each one of them I'm also having. So based on this, I can very well compute the information ratio. So here in the first case, what is my information ratio for portfolio A? Active return by active risk, 1% by 10%. So here my information ratio is 1. Here my information ratio is zero point 0.5. Here it is zero point 0.5 divided by 3%. That is what is working out as the information ratio here, which is 0.167. 0 divided by 2%, so the information ratio is 0. So here I could see that the information ratio is highest for this, and obviously we know that the Sharpe ratio of the portfolio squared is nothing but the Sharpe ratio of the benchmark squared plus information ratio squared. Sharpe ratio of the benchmark squared is always the same, and so the higher is the information ratio, that is the one that can be combined with the benchmark to produce the highest Sharpe ratio. So that's a straightforward kind of a calculation that we can look at. Then we are moving to the fundamental law of active portfolio management, which is a kind of a broad framework which will help us in terms of understanding the potential value added through the active portfolio management. So it is primarily used to size the active weights to each of the assets. It will be helping me in estimating the expected value that is being added because of a particular strategy being taken. So it's a simple mathematical relationship which is trying to find the relationship between the information ratio and a few key parameters of the portfolio. So the basic element that it primarily looks at are, one is the transfer coefficient, primarily talking about the structuring of the portfolio; information coefficient, which is a measure of the skill of the manager; the breadth of the strategy, number of independent decisions that have been taken by the manager in that particular portfolio; and the fourth component that goes into this fundamental law of active portfolio management is the measurement of the risk taking level or the aggressiveness of the manager in actively managing that particular portfolio. Now, if the investment policy clearly specifies what to invest, where to invest, and the manager does not have any kind of a flexibility in the process, then this entire thing is of no use. I can't really play any kind of an active strategy, or I can't measure my measure the value add coming through the active portfolio management. Similarly, if the regulations are in place with respect to where to invest, where not to invest, even there the problem comes up. A few interesting things in terms of the mathematical relationship here. The first thing is with respect to information ratio. What it says is it's a product of the transfer coefficient, which is the structuring. Information ratio is nothing but the active returns by active risk. And now what it is saying is this active risk adjusted return, the main drivers of this are: one, the structuring of the portfolio; two, the skill of the manager; and three, the breadth of the strategy being taken. So the information ratio broadly comes out as the product of these three values: the transfer coefficient, the information coefficient, and square root of the breadth of the strategy. And which means if I really have to look at the expected returns, I'm taking the information ratio times the standard deviation of the return. So this is nothing but active return, expected active return. So we also know information ratio is expected active return divided by active risk. So expected active return directly comes out as information ratio times the active risk. And to go slightly more in detail, information coefficient, it has been observed as the kind of correlation between ex ante return expectations, what has been expected as the return by the manager, versus what were the active actual returns that came out. That's a measure of the skill of the manager. What is he expecting as a return and what is that actually got realized? It's a measure of the skill of the manager. Whereas the transfer coefficient, we are bringing it as from the weights, forecasted returns that the manager has made and actual weight adjustment the manager has done based on the forecasted return. So we are talking of transfer coefficient as a correlation between the actual returns, risk adjusted return, this is the actual risk adjusted return, and the weights that the manager has typically taken, which is a deviation from the benchmark, multiplied by the risk adjustment, active weight adjusted for risk. So these two things drive the transfer coefficient and the information coefficient, and these two are helping in determining the information ratio, which helps us in coming out with the expected active risk for this particular portfolio. Let's look at one quick numerical, right, where these are the deviation in the weights. So manager 1, this is the deviation he has taken in security 1, 2, 3, 4. So he has invested 2.5% more in security 2, 7.5% more in security 3, 2.5% more in security 4 compared to the benchmark, and he has invested 12.5% lesser compared to the benchmark. And these are the expected returns that the manager has really forecasted regarding the security A. The same thing with security B, he did not deviate manager 2 did not deviate from the benchmark in case of security 2. He has invested 20% more in security 1 and reduced 10% in security 3 and 4. Because these are what are his expected returns for each of these 4. Similarly, manager 3, he has invested 5% more in security 2 and 3 compared to their benchmark and reduced the investments in security 1 and 4 compared to the benchmark, because these are what are his expected return. And the overall risk in the overall securities is this, and the actual returns that have been realized are these. So suppose all the managers claim to be good at forecasting the return, so they have forecasted their returns much appropriately. This is what we'll assume. According to the full fundamental law of active management, which manager is best at effectively building portfolios by anticipating the future return? So we are talking about the skill of the manager here. And because I am looking at the skill of the manager, obviously my information coefficient will be the measure that I go with. And we have already discussed the information coefficient is nothing but the correlation between risk weighted ex ante return expectation versus the realized expectation. What did he really expect versus what was the actual? So I can very well take it as the return that the manager A has secured on each one as a risk weight, which is the standard deviation, versus the mean. So I'll take a spreadsheet here, that would be much appropriate. So let me note these things down. Manager 1, his weights are minus 0.125, right? Probably I'll say WM1. Manager 1, these are the weights that are deviating 0.025, 0.075 and 0.025, and his expected returns manager 1, it is 0.03, 0.04, 0.05 and 0.06. Similarly, if I am going with the weight deviation by manager 2, it is 0.20 minus zero point 0.1 and minus zero point 0.1, and expected returns of manager 2 are coming out as 0.04, 0.010 and 0.02. Similarly, the weights of manager 3 deviations are minus 0.05, 0.05, 0.05, minus 0.05, and similarly expected returns of manager 3 are 0.025, 0.015, 0.005, 0.015. These are the expected return. The overall risk is looking like 0.17, 0.1, 0.12 and 0.25, and the realized returns are 6742. 0.06, 0.07, 0.04, 0.02. Now what we are simply saying is information coefficient. If I want, I am trying to take the risk adjusted expectations versus the actual realization. So risk adjusted realized return, if I have to look at, it is this number divided by the risk. So these are my risk adjusted realized returns. Then risk adjusted returns are expected returns of manager 1. So these are the expected return divided by the risk. So this is the risk adjusted expected returns of the manager 1. Risk adjusted expected returns of manager 2. So this is the expected return divided by the risk. So this forms the risk adjusted expected returns of manager 3. Risk adjusted expected returns of manager 3 comes out as this divided by the risk. So these form the risk adjusted expected returns of the manager 3. So I am trying to find the correlation between the actual returns, risk adjusted realized returns, and the risk adjusted expected returns of the manager 1. I have to take it as correlation, risk adjusted returns of realized versus risk adjusted returns expected. So this is 0.53. The same logic if I am going with respect to the manager 2, the correlation is around 0.09, whereas if I am going with manager 3, the correlation looks around 0.67. So manager 3 is having a much higher correlation, which means he is able to forecast things more and more appropriately and whatever he is forecasting is coming very closer to the actuals. So that's how we try to measure the effectiveness of the managers using the information coefficient. Now let's look at another numerical on the same line. Based on the fundamental law of active management, if the portfolio manager has an information ratio of 0.75, information coefficient of 0.1819, transfer coefficient of 1, how many securities are in the portfolio manager's fund? Oh, we know this. Information ratio is nothing but information coefficient multiplied by transfer coefficient multiplied by square root of BR. So my BR or square root of BR works out as information ratio 0.75 divided by the information coefficient 0.1819. So approximately 4 plus. So BR is the square of that. So probably 16 plus is what is the kind of number that is working out. You can do the actual calculation, but 16 plus is a kind of a number that is very well working out. Right, in the making the assumption that the active returns are uncorrelated, I could have got my BR to be around 16 or 17 kind of number. Now, just for the sake of doing, in this case, if I really want to know the transfer coefficient, right, we have here the question was more to do with the information coefficient because we said which manager is best at effectively building the portfolio. So we have clearly concluded. But I really want to know, let's say, the transfer coefficient wise means weightages wise, which manager is more and more efficient. And for that, we have already seen it should be the correlation between one, the expected returns, which the manager has expected, risk adjusted, and that has to be looked at with respect to the changing weights multiplied by their corresponding risk. So that is what we are looking at when we are going with the transfer coefficient, right? So the risk adjusted forecast we have already taken. So the additional thing is now I have to bundle in the weights as well. So I look at risk adjusted weights. So let me call it as risk adjusted weights manager 1. So it is nothing but this is the weight deviation he had multiplied by the risk. So this works out to be the risk adjusted weight of manager 1. So these are the weights of manager 1 across 4 securities. Risk adjusted weights of manager 2 come out as this is the weight deviation multiplied by the risk. So risk adjusted weights of manager 2 come out to be these numbers, and risk adjusted weights of manager 3 come out to be this multiplied by the risk. Risk adjusted weights of manager 3 are going to be this. So based on this, if I want to find out the transfer coefficient, it is nothing but I am taking the correlation between one, what they have expected, This is the manager's expectation versus what is the adjustment they have done to the weights. So this correlation is around 0.72, this is 0.85 and this is minus 0.001. So the manager 2 is very good at deciding the weights. The transfer coefficient is much higher for manager 2. He is very good at understanding how much deviations he has to really make based on the assessment of the risk. So that's one more dimension that we can look at in the numerical. So either I can look at the information coefficient or transfer coefficient, and or even drive the information ratio based on the information coefficient and the transfer coefficient along with the breadth of the strategy. And finally, moving toward the strength and limitations of using fundamental law of active management, especially it is used to select country equity markets in a global equity fund. Timing of the credit and duration exposures in a fixed income fund can very well be determined using the law of active management. But the major drawback lies in terms of ex ante information coefficient, right? Because I require the expectations of the managers on each of the securities, and even the conceptual definition of breadth of the strategy is also a kind of an uncertain element. But yes, once we are able to get into these four aspects, we can really measure the expected active return from the active risk, and very well find out and very well see the contributions and attributions more and more appropriately. So that's how the fundamental law of active management plays a very important role in the portfolio process. So that's what I wanted to cover as a part of this session. If you have any further queries, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.